This is Barry Knapp with Ironsides Macroeconomics at 7:30 a.m. Mountain Time on Monday morning, July 21st. Our note this week was titled, Let's Be Independent Together. We're dating ourselves with the reference to Rudolph the Red-Nosed Reindeer and Herbie, who wanted to be a dentist. But obviously the big topic last week was Fed independence, and there was some evidence in the markets about concern about Fed independence. The inflation outlook in the longer run deteriorated despite what we would categorize as the fifth consecutive downside miss on inflation. The note comprised of an initial section where we discussed what we think is the killer statistic around the inflation outlook, which shows the correlation of the 18 components, biggest components or largest components of CPI, and how correlation has collapsed and what that means for the outlook for inflation and the current drivers of inflation. We then discussed the economic outlook, retail sales, although on the surface looked strong last week, or reasonably okay. In fact, you've seen a real slowing of the economic outlook of the just core demand. We then went on to really dig into the inflation details. We took on that inflation or the Fed independence topic from a whole bunch of different perspectives, and then wound up with wrap the note up with some thoughts on the banking sector and the rebuilding of liquidity after the passage of the One Big Beautiful Bill Act and the associated increase in the debt ceiling, and how cautious Treasury Secretary Besson is being with respect to liquidity, and why that's probably favorable for the markets. So first, inflation correlation, pardon me, is an idea where if you have macro drivers of inflation like we did in 21 and 22, very expansive fiscal policy and monetary policy, you would expect to have high correlation of all those components, prices being driven up together by the same macro forces. That is indeed what happened in early 2022. We got the highest reading we'd gotten, third highest ever, and highest since the early 70s, when similar things were occurring. Fiscal policy was being facilitated by monetary policy. That's no longer the case. Those who ever look at the VIX or trade the VIX and look at correlation as well know that when correlation collapses, it takes volatility with it, and that's exactly what's happened in inflation. There are no macro factors driving up prices right now, so the inflation outlook is benign. Governor Waller is right. We are not in an high inflation risk environment. In fact, disinflation is the underlying trend. That's our big message there. So moving on to the economic outlook, retail sales, just to give you a little broader perspective, nominal retail sales in the third quarter of last year were increased at a 6.2% rate. In the fourth quarter, it was 5.1. In the second quarter of this year, it was 3.2. Real final sales to primary domestic purchasers was 3.2% in the second half of last year, 1.9 in the first quarter. It's tracking 1.2 right now. So growth has slowed. If you get nominal GDP below 4%, that puts a lot of pressure on corporate earnings because of negative operating leverage, companies with high fixed costs in particular. In this case, it's companies that are consumer-facing companies that are being forced to absorb the tariffs into profit margins, and we'll undoubtedly see that through earnings season. We've already seen signs of it. The other point of weakness we saw last week was housing starts, and single-family housing starts are very weak. They're down 18% from December 24. This is yet another reason why the Fed should be easing right now. So we then got into a lot of the details around the inflation reports. Probably the most important factor here is that rent of shelter has slowed decidedly. We had a 0.18 on rent of shelter. All of their housing-related measures are going down, including that sort of dubious owner's equivalent rent. But housing is putting downward pressure on inflation, and it's going to continue to do so through the balance of the year at least. PPI was weak. Services PPI in particular was weak. Import prices are weak coming from Asia. the inflation risks are low. That's the bottom line here. So moving on to this whole independence topic, we think it's a little bit of a tempest in the teapot. We talked about what happened when Volcker was forced out over regulatory policy in 1987 and how it did certainly contribute to the macro chaos that fed into the crash of 87. It's not quite the same situation. Volcker was revered by the markets. We don't think Powell is, but nonetheless, firing Powell would no doubt probably not be the right thing to do here from a macro stability perspective. On the banks, we think although they're trading now at fair value on a price to book relative to ROE perspective, we do think ROE is going up over the next 3 years as regulatory policy loosens, much like happened in the 90s. So we'd stay with the big banks. The smaller banks really need Fed easing to boost ROE to get it above 10. Bottom line here is when ROE gets above 10 in the banks, they don't start building capital linearly. They start building it exponentially, and they can return it to shareholders. They can invest it in private sector loans, improve spreads, and returns even more. And it's likely to be a very favorable environment for the banking sector in the coming years. So we would stick with those stocks. And then, as I mentioned, Treasury Secretary Bessent appears to be being very cautious about rebuilding the balance in the Treasury general account so as to not drain liquidity from the system. So that's one of the risks that he seems to be managing well. This is a Treasury Secretary unlike any other we've had in recent years who really knows the markets. So that's it for us this week. This week will be primarily about earnings and the capital spending outlook from some of the regional Fed surveys, the preliminary PMIs. We may be late getting our note out this week. You all are free subscribers here. You should consider becoming a paid one. The note had a lot of great stuff in it this week. It's very detailed. I can't do it justice in a 7-minute little video here. Barry Neff from Ironsides. Have a good week, everyone. Thank you.